Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Hello, ladies, gentlemen, animals, and aliens. We haven't discovered them, but maybe they're listening in. I don't know why that's a sound for an alien, but that's what came out of my mouth. Charlie Jewett with the Renovating Retirement Podcast, bringing you episode 76 in the middle of a series on home equity planning or mortgage planning, which is where I cut my teeth, baby. That's where I started. The first 3 or 4 years, did hundreds of these plans. People that set them up the right way are still enjoying the benefits today. You can screw this up, and I've seen clients screw it up. But when done right, this is an amazing, amazing improvement to the old pay off your mortgage strategy, which is outdated, untrue, unsafe, and not good for you. Charlie, what are you talking about, you crazy man? My mama told me to pay off my mortgage. She can't be wrong. I know. It's very, very traditional to pay off your mortgage, but like every tradition in the world, you need to frequently question it, say, is it still true? And with today's mortgages, since the Depression, today's mortgages, even though we've had them for a really long time, it is safer to actually keep them than to pay them off. We saw in the last podcast that home equity, any and every dollar you stick inside of your home, is not liquid enough. It's not accessible enough in bad times to pass the wise investment test. You put it inside the house, and if you have depreciation, it disappears. If you lose your job and you can't get a mortgage, you can't access it. If you lose the home to a natural disaster and the insurance company wants to fight you, you can't access it. Are those things going to happen to you? I hope not, but I know people in every one of those situations who could not access their home equity and have suffered. What's test number 2, or what's this podcast called? This is called Home Equity Fails the Safety Test. Safety, when you're looking at a wise investment, means, can I lose my money, right? So this is the second test to see if home equity passes, as a wise investment. What this test seeks to know is whether or not you can lose any or all of the investment you make in a home equity or in money you put inside of your house. In other words, is home equity safe from losses? Let's take a look at that $250,000 of home equity we're using in our example. We're talking about a $500,000 house. Someone has paid it down to $250,000. So of that $250,000 of home equity, let's ask, is it safe no matter what happens? Well, let's measure home equity as we would any other investment. This is important. If you're going to read books and listen to teachers who say the single most important thing you can do for your finances is buy a home, make a large down payment, and try to get it paid off, you should probably check and see if that's true. Let's say your home is worth $500,000. You don't have enough to pay cash for it, but when you go to purchase the thing, you put down a $100,000 down payment on the home. And you take out a $400,000 mortgage. This is very traditional, by the way. 20% down payment, 80% mortgage. You put $100,000 down on a $500,000 house, and you take out a $400,000 mortgage. Unfortunately, as happens from time to time, market values of homes can drop, and your home can depreciate in value, right? Yes, we saw that in 2008 and 2009, and we will see it again someday. Is it possible? Absolutely. You know it's possible. You don't know when it's going to happen, but it happens, and we're going to see it more and more in the future as the baby boomers try to get rid of their big properties and sell them to the 1/3 of the working force that's young and has no money. When the value of your home goes from being worth $500,000 to being worth only $400,000, what exactly happened to your $100,000 down payment that you put inside of the home? Yes, it disappeared completely. Any down payment you make on a property is the money most at risk to depreciation. You lose your money first, which is why veterans have such an amazing advantage over the rest of us, because they can buy houses with 100% financing. Their own money can stay inside their investments where it's safe. They don't have to make a risky down payment that they then can lose if the market decides their house is not worth what it used to be. If you refinance, you can't even get the money out. House is worth $500, you put $100,000 down, house value drops to $400. You go to refinance, well, you can't get your $100,000 back. You can't do anything. It's gone for good until you wait for properties to go back up in value. If you sell, you can't get it back. It's just gone until home values now go up by 25%. That $400,000 to get back up to $500,000 has to be a 25% increase in the value of that house. You'll be waiting a while. The market decided your home is not worth what you paid. And all the money you put inside that home just disappeared. This is where the pundits and the terrible book writers say you should put all your money. Put a big down payment on a home and make extra principal payments and do a 15-year fixed mortgage and blah, 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 blah. They even get inside the churches and teach this trash. And yet it's the money that's most at risk to something we see happen all the time or from time to time, which is depreciation, and you never know when it's coming. Whether you put the money into the home by making a down payment or the home went up in value so much that you have an extra $250,000 of home equity, like our example, both of them are exactly the same. You are not guaranteed to have that money in the future. If you leave money inside of a home in the form of home equity or value, you can lose it. It is not safe. Depreciation can take it away anytime the market chooses. Can you actually say that your home equity is safe from depreciation? Of course not. The answer is no. For that single reason, I would say that home equity is not a safe investment. The solution to the problem is a strategy called depreciation insurance. The idea is that if the market goes down, you need to protect your money from losses. Before 2008, this was easy. You just call any bank and say, I want to do a 100% cash out refinance and put my home equity somewhere else. And they drooled a little bit, gave you an incredible quote, and we did it. Half of them didn't even want to see documentation. But we're in the new world of mortgages, and unless you're a veteran, you can't do 100% financing anymore on a cash out refinance, which means you cannot protect all of the money that's inside of your home. So don't put extra money in there. Trust me. If you put a large down payment on your home, you have a great job, and are making extra principal payments, you will have created a good amount of home equity for yourself. Assuming you've got a $500,000 home, but you've paid the mortgage down to $250,000, you've got $250,000 of home equity, and then all of a sudden, you hit hard times or have a medical condition and go on disability, and guess what happens? In that situation, you're going to face the same issue with your mortgage broker as in the last podcast on liquidity, where you approach your mortgage broker and say, I want to take that money out of my house. And he says, no, you don't have the ability to repay. We don't care about the $250,000 value because banks know depreciation can take that away at any time, so they don't even count it. They just want to know, do you make enough money to make our payments and give us what we want? As far as mortgage underwriting is concerned, being on disability is a lot like having no job at all. Unless you can show the ability to repay the loan long term, the bank will not allow you to take cash out of your home or refinance at a lower rate. It's more common than you'd think, people. And if you can't make your payments, there's a good chance the bank is going to come and take your home in foreclosure, particularly if there's a lot of equity inside of that home. In some states, the bank actually keeps all of the home equity that you've paid into the home during the entire time you lived there. Even though you've built $250,000 worth of equity inside that house, you lose every penny of what you've built because you can't pay that mortgage for 3 to 6 months? In light of all this, can we say that home equity is safe if you go through a foreclosure? The answer is no. It's not safe if you go through a foreclosure. It's not safe if you can't make your payments. It's not safe from depreciation. Now, if you actually lose the home to a natural disaster and didn't have the proper insurance on it, your equity is certainly not safe from losses in that situation either. Like many of the people in New Orleans and along the Jersey Shore who've still not been paid on their claims, you will lose some or all of your home equity that took years, if not decades, to build up. Therefore, we've learned here that home equity has low liquidity. In the last podcast, we talked about it due to how hard it is to access in down times when things aren't going well with your income or with the house. You can't refinance or even use your lines of credit, so you cannot access your home equity. In addition, now today, we've learned that home equity is not really safe if something goes wrong with the value of your home, depreciation, or if the home itself is somehow compromised, cracked slab, falls in a hole, falls off a cliff, gets flooded, gets blown over, burns down. That's what you need to understand here. If a strategy works only when things go perfectly, but fails when things don't go well, then it cannot be categorized as a wise and conservative strategy. Putting equity inside of a piece of real estate is not conservative. Let me say it again. I don't care how many silly, ridiculous authors or deceitful podcasters or radio show hosts say this. The truth says home equity is not conservative. Putting home equity inside of a piece of real estate and praying that nothing goes wrong is not conservative. You hear it yet? A good financial plan works no matter what happens. Long life, short life, rough life, sick life, into the next life. At the very least, it covers most situations in which one might find themselves in. Before I introduce you to a more conservative way to handle your home equity, what do you do if you're not going to put it inside the house? We need to do the next two podcasts. We have to take a look at the rate of return. Is home equity making any money? If it's going to be a wise investment, it better make us some stinking money, right? That's what investments are. So next podcast, home equity fails the rate of return test. And the one after that, home equity fails the tax treatment test. To put home equity or to put your money inside of your home actually hurts you and you pay more on your taxes. People, keep listening. Couple more to go. Be back soon in a day or two because I think you people are the best.
Renovating retirement with Charlie Jewett.
But that's all, folks.